Hello everyone and welcome back. Today we're talking about one of the hottest questions on every investor's mind right now. Should you be buying silver or gold in 2026? Before we dive in, take a second to hit that like button. It really helps this video reach more people who are interested in silver and gold, just like you. And for hitting that like button, here's a picture of a panda. Let's get into the video. Both metals have had massive moves recently. Gold hit record highs above $5,000 a couple weeks ago, and silver even pushed past $118. But then both pulled back sharply as markets reacted to macro news and monetary policy shifts. In this video, we're going to break down what's currently driving each metal, the latest analyst forecasts for 2026, demand and supply dynamics, and whether it makes sense to be accumulating right now. Let's dive in. Gold and silver both surged in late 2025 and into 2026, driven by geopolitical uncertainty, central bank buying, and historically low real interest rates. Investors began shifting into precious metals as a hedge against inflation and risk, while industrial demand pushed silver even higher due to its critical role in solar, EVs, and technology. Then at the end of January, both metals experienced a steep pullback, gold down double digits and silver down significantly, after markets reacted to changes in monetary policy expectations, including a new Fed chair nominee and a stronger US dollar. This volatility has raised the question, are precious metals still worth buying? Let's break down the reasons for and against. Let's start with gold. Safe haven demand is still strong. Geopolitical risks and economic uncertainty remain elevated in 2026. Tensions with global powers, trade uncertainty, and fiscal risk keep gold's appeal intact. Central banks are continuing to accumulate bullion, especially in emerging markets, which is a structural demand driver that isn't going away. Long-term supply constraints also support gold's case. Mining production grows slowly, and it takes years to bring a new mine online. That means supply can't easily expand to meet rising demand, reinforcing a long-term bull thesis. Analyst forecasts for 2026 still show potential upside, with average prices expected in the mid-$4,000s to nearly $5,000, and aggressive scenarios pointing toward $6,000 if risks intensify. In short, gold's role as a hedge and long-term store of value remains intact, even if prices are volatile in the short term. Now, let's look at silver. Silver isn't just a monetary metal, it's also an industrial metal. Demand comes from solar panels, EVs, semiconductors, and other high-tech applications. As the global economy grows and green energy demand rises, silver demand rises with it. Silver has run a structural supply deficit for years. Demand exceeds mining production on an annual basis. Much silver is produced as a byproduct of other metals, meaning supply doesn't ramp up easily when prices rise. Because silver's market is smaller than gold's, price swings can be more dramatic. Some analysts still view silver as a strong buy in 2026 due to supply constraints and industrial demand. But others caution that silver may underperform or remain volatile if industrial demand softens. So how do gold and silver compare? Gold is historically a store of value, has strong safe haven demand, central bank accumulation, structural supply constraints, and is less volatile. Silver has strong industrial demand, supply deficits that could tighten further, potential for higher percentage gains, but is more volatile and unpredictable. In simple terms, gold is typically a pure hedge asset, while silver behaves like a hybrid, part safe haven, part industrial commodity. If you're considering buying either metal in 2026, keep an eye on macro trends. Interest rates and real yields are crucial. Lower rates or negative real yields make precious metals more attractive. Dollar strength or weakness also impacts prices. A weaker dollar generally supports higher gold and silver prices, while a stronger dollar can push them down. Geopolitical risk events can rapidly increase safe haven buying. For silver, industrial demand trends are especially important, including growth in solar, EVs, and electronics. Here's how different types of investors might think about buying. Long-term hedgers who want protection against inflation and currency risk should consider gold. Investors looking for growth potential with higher volatility may consider silver. Dollar cost averaging can reduce the risk of buying at a short-term peak. You can buy physical bullion, ETFs, or minor stocks. Each has pros and cons. Physical metal means you hold the metal itself. ETFs offer liquidity, and miners offer leverage to metal prices. It's also important to consider risks. Central bank policy may tighten unexpectedly. A strong dollar can cap gains. Silver's industrial demand could soften. Market liquidity and short-term futures moves can spike volatility. Being prepared helps you avoid emotional buying and selling. So should you be buying silver or gold in 2026? This is the question I get asked from a lot of people. Let's talk about that. If you want hedge and stability, gold is the go-to. If you want growth potential with higher volatility, silver may be worth considering. Both metals have compelling bullish cases this year, but they play different roles in a portfolio. If you enjoyed this video, drop a comment and let me know which one you're stacking and why. I read all of your comments and enjoy the feedback. If you found this helpful, hit like, subscribe to the Silver Thesis channel, and I'll see you in the next video.